music today. Thank you very much, Sean. Happy Wednesday, everyone. Welcome to another session of RMS Smart Investing classes. And today, in the mix of all the earning seasons and all the excitement, I thought let's talk about earnings. And the main thing I'm going to speak about today is about earning surprises and whether we can take advantage of these earning surprises and have extra benefit and profit out of these. So when we talk about, again, we're in the middle of the earnings, and as you know, in all the firms, all the companies that are publicly traded in the United States, they are, according to Securities and Exchange Commissions, the SEC, they have to disclose their financial data basically on a quarterly basis and on annual basis. And then we talk about, again, the financial information. Mainly we talk about the balance sheet, the income statements, the cash flow statements, and the other relevant financial information about the company. So this way, the public has access to that and they know what's going on. And it has to be done within 45 days. So what happens, majority companies, they do it within 30 days after end of their quarter. So far, so good. Most of the companies, they stand by that. And if you notice, sometimes when the companies do not come up with their timely manner of reporting, they get punished. And it seems like maybe there's something that they have to work on. So that's one of the things that you watch for some of these kind of information that the company wants to delay the reporting, and they are actually allowed as long as they say, but obviously the markets do not like that. Sometimes they come up and they say they have to restate, which is actually is like a death wish in some ways. That usually when there's a restating that or adjusting their financial statement, it's usually not for a good reason. Usually it's not a positive thing. So those are the things that you have to be aware of. Today, what I want to talk about is something called the earning surprise. And what these earning surprises are, we want to go deep into that and see, again, can you take advantage of that? So an earning surprise occurs when the company's actual earning per share comes above or below the analyst's expected projections. So basically, analysts are working very hard. They're in touch with the company. They're in touch with the suppliers. They're in touch with consumers. They're digging into all the numbers. So they're trying to be as close to the earning numbers as possible. So even after that, all the adjustments, when they miss it in a sense, and the company surprises them, then what happens is the market takes it in an interesting way. Either they get punished or they get rewarded most of the time. So what is the surprise? Again, it's a percentage is actually having the actual number minus the surprise number and divided by the actual times the 100%. And this will gives us a surprise percentage. So whether it's up or down. So one of the things is I mentioned about analysts, there are some services that their job is they look into the earnings, constantly dig into all the data, and they come up with the earning estimate services. We have the fact set usually comes up to all kinds of information, but like the Thomson Reuters or the S&P Capital IQ or ZAX, these are the most the biggest ones. And you can see the Thomson Reuters, the IBES, the S&P, you can see that. And then ZAC, you have a free site, but you could have the paid subscription if you wanted to. And they do come up with the consensus earning estimates. And they've tried to be as close as possible. Over the years, they keep getting better and better. So they track all the analysts, and you can have access to all these again through their website. Estimize is another one. So what happens with all that information, all these analysts being on top of things. They're talking to the management. So how could we have the surprises? And one of the things, today, for instance, we had the Facebook. Yesterday, we had like Microsoft and Apple, and we had Google of the world. And you've noticed that a lot of these companies come out with the earnings. Usually, when they have a great earnings, they beat the estimates, and yet they go down. They get punished. And sometimes you see that the earnings is negative, and yet they're up. The next day you come back and let's say you shorted the stock thinking that they had it, they haven't been doing good. The earnings are not that great. And the next day they gap up and it's like, it's shocking what happens. And hopefully after end of class, you will see that one of the reasons again is the surprises. And what happens is they actually beat the consensus. And what happens because the whole thing has been based on the given facts, with the numbers coming up, it almost has a domino effect. And it changes the whole, let's say, the analysts and let's say the portfolio managers, we are looking at the valuation of the company. And just by having a little change in the earnings or the projections, all the, let's say, if we look at the discounted cash flow or we look at the discount dividends, or once there's a little change, it changes the whole valuation. And that's why it's important. These earnings are very important in the projection of the pricing. So basically what I thought, let me share with you my 7 criteria, what I look at, plus a bonus, how we can take advantage of these earnings surprises, and how does this happen. Before we go in there, remember, one of the things is there is the earnings estimate that, well, the markets look at, and then, you go to Yahoo Finance and you see what is expected. And there's the whispers number, and that a lot of, again, the analysts follow that. So let's say the consensus is this. There's a whisper number, which is actually even higher than that. So what happens sometimes when the company meets the consensus, but it doesn't meet that whisper number, they get punished. Or on the downside, maybe the analyst knew something and then the consensus was one number, and let's say in a downside, and it comes better than that, like it beats that whispered number, they thought it's going to be really bad. The company is better than that whispered number. That's how they get rewarded. So these whispered numbers are also important. So it's not just a consensus, it's also the whispered numbers. So let's talk about the earnings surprises. So what I look at, basically earnings surprises, and usually when these surprises happen, there's revisions based on the analysis. And so usually if it's like a really good thing, they usually gets revised upward. If it's bad, it gets revised downward. So, and we will discuss that a little more. So in my 7+ criteria, the number one thing is you have to understand that the markets are forward-looking. We just talked about the use of discounted models to price it. So what the price that you're looking at today is basically it is already discounted. So it's what is the market's thinking is going to happen in the future. So they base the pricing on that. So it's based on expectations. So it's not like today they come out with the news that the market has already taken into consideration. You've seen it that let's say in auto industry, they come and say, oh, they're expecting that they're gonna sell so many cars, which is saying, oh my God, these are great numbers. Well, the market already knew about that. So basically there's no surprise. They already priced in it. So average retail investors, for instance, goes in there and over the weekend, they read the news and they say, oh my God, this is such a wonderful investments. They're doing so good in their sales. Well, that's already baked in the news, and it's part of their price. So that's why they get, unfortunately, surprised that the markets didn't react the way they thought. And again, the other thing is this current price, it takes into account the consensus earning estimate. So they're basing on what the analysts have thought about. So that's number one. So you have to have that understanding. Now, the second thing is, once there's that big surprise, and let's say upward or downward, what happens, that immediate reaction usually, because there's a surprise, it, let's say if it's a very good number, it beat everything, and was again, it beat the whisper number and it's up, it has a lasting effect. So if it happened this quarter, and this is important in your investment management, even we will talk about maybe in your even options if you want to think about short term, and but even if you're looking at the long term, and let's say this surprise happened today, for instance, it's not just for this quarter. Usually it has momentum, and the studies have shown that it could go on for next 4 quarters. So that's, I think, it's important to understand that. So if the trend has changed and we're getting these surprises, these are the good stocks to stick with. The third thing is, because the larger companies have a larger following, basically based on the analysts, a lot of portfolio manager institutions are involved with that. When there are surprises, and let's say they have a momentum changes, the upside was a big surprise, it's because of the law of averages, because there's so many people following them, they react a lot faster, and it kind of resolves itself a lot faster. So even though it could have a lasting year, but the effects might not be as much as smaller firms, firms that not a lot of analysts follow, firms that a lot of portfolio managers do not follow. So this, it can continually surprise the analysts and investors, and it will have much bigger movements. So I thought that should be important to know that they actually, again, the larger firms, they act quick and they do have the reflections, but then gradually the understanding is that, but the smaller companies have, as far as the revisions, that they have more potential, in my opinion. The other thing is, I mentioned to you about up to year. So if there is a surprise in 1 quarter, there's a good chance that that will be many more surprises coming in coming quarters. So that's another thing you want to look at, and we will take advantage of understanding that, and we can even look at some maybe option strategies around that. So now that, let's say we have some candidates and you know that they last 2 quarters or last quarter, they really had a up revision, they really beat the estimates, they did really well. So the odds are they could do better. So we will discuss that in number 5, basically just following up on that. So what we want to do, we want to buy stocks that they had these positive earning expectations. Now you can be a holder of that and be maybe for 1 year or so. And you want to avoid the stocks that had the downward revision and they had a downward earning surprises. So what happens is, in this situation, perhaps maybe even you can sell the stock before even earning is due. That would be one. I'm not even saying sure. Let's say you're a holder of it, or you want to buy the stock even before the earnings because they've had a good surprises. That might be a good chance to go up. Now, if you're an option player and maybe you want to do the short term or you want to do verticals, maybe it gives you a little bias towards that. So you can go and look back and look at the expected move, which is the 1 standard deviation, look at the 2 standard deviation and see how they reacted the previous one, the previous quarter or 2 quarters ago. And based on that, have a like kind of a set of a bias, again, based on the earnings surprises. So, and maybe have a little, bullish bias and play it accordingly. As we're talking about these, so this is granted, okay, there is a surprise, it's good, the numbers came really good, they beat the estimates, but you want to dig a little more into the company though, in the meantime. Let's say, especially it's the first time that you see this earnings surprises happen. So we look at the quality of earnings. Quality of earnings are important because we want to understand this earnings. are based on accounting gimmicks? Is it based on really, let's say, cost cutting, which happened a lot last year, if you recall? Is it sales of assets, or is it really a real quality of the revenue are increasing? They're having new markets. They're becoming more competitive in different markets. So that's the quality of earnings. So we want to look into that. So you have to make sure. Also, you want to make sure that there hasn't been some management changes in the meantime. So I mentioned to you the 4 quarters continue, and that, but in the meantime, you want to watch for that as well. The industry trends change, and basically sometimes they come. If you notice, there are times that with the earnings come and they're great, but then the management comes and they give you, as far as a forward guidance, they are not very convincing. They think things are not going to continue. So you want to pay attention to those. So what we're talking about here is, again, it's a little more general in the sense that, okay, I'm looking at the history, like the 1 year lasting, but you still have to do some homework, right? Number 7 is the revisions of 5% tend to make for really above average returns. So if the estimates all of a sudden after earning, or when the analysts come and say, well, it just revised the whole earnings up 5% more, 5% or more, then they usually have a better than average returns, these companies. And because of the revisions that keep happening with analysts, usually you will have a better earning surprises. Now I put down 7 plus 1 is continuing on the number 7 is, in average, believe it or not, there are more positive quarterly surprises than negative. And why is that? So when the analysts get encouraged and they see these positive quarterly happening, there's more analysts are following these positive quarterlies, and so there's even more happening because of more people are following. So with the positiveness, there's more positiveness. So that's why it is on a quarterly basis, you get uh, more positive surprises than negative surprises. On the other hand, what happens is on annual basis, the studies have shown there's no biases. So there's no bias toward positive or negative side of things. Okay, I hope this was helpful. It was just a little few criteria. I think it's important to understand how the markets work. I want to share this. American Association of Individual Investors, they have like great screens, and they look at all different kinds of screens from the gurus. For instance, they follow, let's say, Ben Graham style, or like Warren Buffett style. They look at the value versus growth and momentum. They look at the ADRs. And one of those, we look at the factor models. This is one of them. And they looked at, like, we combine all 4, but in one place. But they, once you can see, the blue color is the estimated revision, and they look at the top 30 companies that their revisions have been, they're in the top 30 companies of all the companies who had been revised upwards. And then there's another screen that they use is anything which is up 5%. So that's the yellow and the blue. You can see the yellow and blue basically are very much neck and neck. So then we have the companies who've been negative, -5, and then you have the S&P 500, what they have done. So they're very much, believe it or not, it's like, because these 2 screens have done so well, and this goes back to 1998, it's there's not much separation on the bottom. So basically you can see from since inception, this revision style has averaged 24% annually. Just this year alone, they're up 37.3%. 5-year average has been 23.9, and 10-year has been 19.3%. Now the alpha is what they have done above what S&P returned, which S&P has done magnificently for the last 10 years. For instance, they have beaten S&P very handily. So it is basically, when I studied this, it's like it's the number one performing screen, and in the different time periods. And again, you know what kind of year we had last year, what kind of a decade we've had, I know, past 10 years. So this has done magnificently. Now, what they do, the average holding is 30 months. So once this whole thing has started, they like to hold that stock for up to 30 months. And the turnover is pretty low, it's 15.3%. And this is as of June 30th. We don't have, again, because it's not end of the month, they look at these at the end of the month. Usually it's the second week of the following month. In mid-August, we'll have access to what happened in July 31st, for instance. So this is their history. It has been very successful, and that's why I want to share with you. So as far as this screen, what do they look at is basically what are their criteria for this is they want to make sure there's more than 4 analysts that follow these earning or they do the earning estimates. So they don't want to have like just one analyst or 2 analysts. So it's very much, it's a very narrow pool. So they like to have at least 4. And the rest is, again, they look at, they want to make sure it's like a 1 month compared to 1 month ago is this estimate has gone up, the surprises happen. And basically, I'll let you read it. But the thing is, it is all about positive revisions. And what they want to make sure there is no downward revision in the earnings estimates for the next fiscal year. They choose the 30 companies that have had the 30 largest percentage increase in the current year consensus. And what they do, the alternate things that I showed you that screen is they look at, they want to make sure the earning estimates have been revised upward by 5% or more. So they have 2 screens, but you could see how similar they were. So I want to go one step further, and I want to see if we had this screen, what are the stocks that they will pass this estimated, the revenue upward at the top 30 of these companies, and here they are. So you can see basically, the up division, and they're the top 30 companies, and this is, they're on NYSE, the New York Stock Exchange, or they're on NASDAQ. So these are the symbols, and this is as of last night's or yesterday's closing. So this is like hot off the press. I won't have these access till tonight, but I thought to share these with you to give you some ideas. Maybe you look at some of the charts, see what they have done. Some of them had a nice gap up, and then you can see there was just some nice movements happening with these stocks. So believe it or not, that's about it. I want to make sure it's a concise and just a one idea. But earnings are, as you know, they're the engine of the prices in a sense. So it's very important because that's what it is. It's the revenues, but also the net earnings are what really makes the valuing the company, the pricing of the companies based on their potential growth and how they have basically have performed. So that's why the earnings are very important. So with that in mind, believe it or not, I think some of the shortest classes I did, but I just want to just go to the point and share that with you. I hope it was helpful. And with that in mind, Sean, we can stop and then we can answer any questions that anyone has.